Henry has the controlling interest in Company H, which has two classes of shares of equal market value. A class ordinary shares acquired as pre-CGT assets, and B class ordinary shares acquired as post-CGT assets. Henry, as the controller, causes Company H to vary the rights attached to the B class shares, such that they no longer have any voting rights and only limited rights to participate in dividends and capital returns. This scheme decreases the value of the post-CGT B class shares and increases the value of the pre-CGT A class shares. In other words, Henry has caused a value shift from the post-CGT B class shares, referred to as a down interest, to the pre-CGT A class shares, referred to as an up interest. In the absence of any anti-avoidance provision or adjustment, Henry could sell his pre-CGT A class shares completely free from CGT and enjoy a reduced capital gain, or perhaps a capital loss, on the post-CGT B class shares. However, under the value shifting provisions, it is likely that disposal treatment applies, given that Henry has shifted value from a post-CGT asset to a pre-CGT asset. The cost base and reduced cost base of Henry's A class shares would increase based on the value shifted. As there was no pre-shift gain for the down interest, the cost base and reduced cost base of Henry's B class shares would decrease in line with the proportion of market value of the down interest shifted. Jenny owns all the shares in Company J and wishes to introduce her son Jason as an equity holder. A simple direct sale or gifting of shares by Jenny to Jason would trigger CGT in Jenny's shares. Instead, Jenny causes Company J to issue new shares to Jason at less than market value. This effectively shifts value from Jenny's shares, a down interest, into Jason's newly issued shares, an up interest. In the absence of any anti-avoidance provision or adjustment, Jenny would avoid CGT on the shifting of unrealised capital gains and enjoy a reduced capital gain, or perhaps a capital loss, on the future disposal of her shares. However, under the value shifting provisions, it is likely that disposal treatment applies, given that the value of interests has shifted between separate owners. The cost base and reduced cost base of Jenny's shares would decrease in line with the proportion of market value of the down interest shifted. Further, as Jenny has a pre-shift gain for the down interest, CGT event K8 will occur and Jenny will be liable for capital gains in respect of the entity interest direct value shift. For Jason, the cost base and reduced cost base of his shares would increase by the value shifted. The purpose of the value shifting regime is to counteract arrangements that shift value out of some assets into others, causing a distortion between market values and tax values. The shifting of value could artificially create a loss or reduce a gain in one interest and create or defer a gain in another interest. Division 725 considers direct value shifting between equity or debt interests in a company or a trust. This could be by varying rights between interests, such as different classes of shares, or issuing new interests at a discount to market value, such as issuing new shares for a nominal value. Only affected owners are impacted by the value shifting regime. These include controllers or their associates, or any active participant in a scheme involving a closely held entity. The consequences for affected owners depend on whether disposal treatment or rollover treatment is triggered, which in turn depends on the type of asset, the type of interest, and the affected owners. In general, for the holder of an up interest, there is an increase in tax values reflecting the value shifted in, such as an increase in cost base. For the holder of a down interest, there is a decrease in tax values based on the proportion of market value shifted out, such as a reduction in cost base. CGT event K8 may also be triggered where there is a pre-shift gain in the down interest under disposal treatment. However, the direct value shifting provisions relating to entity interests are ignored where the de minimis exception applies, being where the direct value shift in down interests is less than $150,000, or the reversal exception applies, being where, under a scheme, any value shift is likely to be reversed within 4 years. That said, the Commissioner still reserves the right to apply the general anti-avoidance provisions in Part 4A of the ITAA 36 in situations where the direct value shifting regime is not triggered. To recap, Division 725 considers direct value shifting schemes for equity or loan interests in companies and trusts. The provisions aim to protect against artificial shifting of value from one interest to another, whether through varying rights of the interests or issuing of new shares at a discount. In such cases, adjustments will be made to the tax values of the interests, and CGT Event K8 may also be triggered.